Welcome to this Killick Explains video and welcome to part 2 of a 3-part series on famous investing catchphrases. What we're exploring is what are they and how useful are they in the context of making investment decisions, given they're widely quoted actually across websites, in the newspaper and in books. So part 1 had 5 of them, if you missed part 1. Part 2 is going to be another 5 coming up, and then part 3 a final 5 to make 15 in total. So let's start with a cracker. The market can remain irrational longer than you can stay solvent. Now what that's saying basically is it's all very well being a contrarian. Now a contrarian is somebody who doesn't do what everybody else is doing, everybody else being the market, all right? And everybody else can be irrational for a long time. In part 1 I talked about the importance of momentum. I talk about irrational exuberance. So if you're going to bet against that, if you're going to be greedy when other people are fearful, as Warren Buffett once put it, great, but it's hard, okay? So you've got to have the courage of your convictions. You've got to be liquid, right? If you're going to buy out of fashion unpopular stocks, that's probably the right thing to do, but you may have to have patience to realize your profits, all right? If you're betting against the crowd, in other words, you've got to be prepared and ready to stay the course, because people literally go bust trying to hold on to positions that actually they can no longer finance in extreme cases. Now, some rules of thumb, all right? Betting against the crowd, being a contrarian is a good thing to do. It is difficult, but be careful, all right? Rules of thumb, never bet on single stocks, no matter who you are, okay? Either as a momentum investor, that's someone who just follows the crowd, all right, hops on the ride and stays there, or as a contrarian, who at a certain point says, no, this has gone beyond any sensible valuation metric. Don't buy single stocks, always diversify, and don't stay out of the market for too long. In other words, if you're the kind of person that will dump a stock or a sector or an index or a collection of ideas because you think they got too expensive, have a plan. Recycle into something cheaper. If you're going out of growth, go back into value, and vice versa. Don't sit on the sidelines having your money eroded by inflation. A point I've made many times before. Quote 2, catchphrase 2. This one credited to John C. Bogle. All right, many people think he was the inventor of the exchange-traded fund. More about that in a moment. Don't look for a needle in a haystack, buy the haystack. Now that is quite a nice way, quite a neat way of saying, basically, you don't need to be an active investor. Active investors scrabble around looking for the next best idea. Sometimes they win, sometimes they lose. Just buy the market. Buy an index. Passively track the FTSE 100. Don't worry about the 100 individual components of it, if you like, and which ones are expensive, which ones are cheap. So it's the active versus passive debate by another name, if you like. Now, my view, which isn't shared by everyone, is nuanced on this. If you're looking for a simple, cheap, efficient way of tracking a well-known market like the UK, like the US, possibly like Japan, all right, then fine. An exchange-traded fund will give you reasonably cheap, reasonably efficient, reasonably quick access to that particular market, all right? But if you are looking at markets that are more difficult to access, more difficult to weigh up, where you may get patchy coverage from an exchange-traded fund unless you look carefully under the bonnet, where expertise and local knowledge really do count, all right, then active investment has its place. And I'm not a big fan really of what are called active ETFs because they can get quite expensive. So my view is sometimes you want to buy the haystack and sometimes you want to look for the needle. Stocks take the stairs up and the elevator down. Now I mentioned something related to this, another catchphrase in part 1. This is basically saying that over time, stocks make steady progress on the way up and then can rapidly drop. And as I mentioned in part 1, you've seen that several times in the past. The Russian invasion of Ukraine, the start of the war, as it's been called, between Israel and the Gaza Strip, Hamas, if you like. Then you've got the financial crisis, then you've got the dot-com boom and bust. So plenty of examples of where stocks have crashed pretty hard and fast, but eventually recovered, even if that recovery takes time. All right, so my advice is, yes, to a degree, stocks do take the stairs up and the elevator down, but be careful. Number one, make sure you understand where we are in a particular market cycle. Make sure you're always investing ready for volatility. If you're not sure about committing a lot of capital, do something called drip feeding to pound cost average your way through rough patches. Make sure you stay invested. Point number two. In other words, don't use the catchphrase as an excuse to market time. All right, see if you can catch the market at the bottom. And the reason for that has been demonstrated by many studies. JP Morgan have done one of them that shows that if you miss the best investing days over, say, a 10-year period, and they tend to follow the sharpest dips. So that's where this rule of thumb falls down. If you miss that bounce, you can hammer your average returns over, say, a 10-year period. So that's where, as an observation, it's reasonable, as something you can actually use as an investor of limited use. Next, Warren Buffett, be greedy when others are fearful. Now, this is basically expanding on the contrarianism point I made earlier in this video. It's all about saying when stocks are on the floor, when everyone is scared, when no one's buying, that is precisely when you look for opportunities, whether those opportunities are individual stocks, funds, indices, whatever it might be. Okay, the trouble is it takes a huge amount of courage and it takes liquidity, all right, to stay invested at a time when markets are wobbling and so on. So my advice is, yes, by all means, try to be greedy when others are fearful. Try not to be fearful when others are fearful at the very least. But if in doubt, committing regular sums to the market will take away the need to worry about exactly at what point most people are fearful, most people are greedy. There are studies that are done. There are gauges out there. There are fear gauges, as they're known, one's called the VIX in Chicago. But unless you're a market professional, they're quite hard for the average person to read and interpret correctly. Finally, economists predicted 7 of the last 3 recessions. Boom. What that's saying is forecasting is dangerous and not to be trusted. People make a living at a forecast, and we like certainty. We like to look ahead. We like someone to say, this is what is likely to happen to him. And there's no harm in someone putting out that view, because then we can at least challenge it. The sign of intelligence is hearing an opinion and not agreeing with it, as was once said. So there's no harm in forecasts unless you actually believe them. Be careful. Basically, remember that stock prices try to anticipate what's going to happen in the future. So don't think because you've seen a forecast that you can somehow get ahead of the market, highly unlikely. And secondly, remember the economy and the stock market are not the same thing. I've made that point in other videos. Although they head broadly in the same direction most of the time, whether up or down, there's a huge timing lag because of what I just said. Stocks are always looking ahead. So you can be in an economic dip and the stock market can be rising and vice versa. So forecasts, interesting, all right, something to think about and challenge, but not something usually to act on as a long-term investor. Okay, there you have it, 5 more rules. If you'd like to read more or see more on any of those topics, then I recommend our website, killick.com/resources for other videos, copies of Confidant, our quarterly magazine, and my how-to guide on investing in equities.